Good morning, everyone. This is Barry Knapp with Ironsides Macroeconomics. It's Monday morning, December 9th. It's 9:30 a.m. Eastern Time. I'm in New York City for the week to see clients, a little bit of family, with a day in Boston for a group lunch on Wednesday. We released our 2025 Outlook note this week titled Targeting a Trifecta. That's a reference to incoming Treasury Secretary Bessent's three arrows. That's a 3% budget deficit, 3% growth, and 3 million barrels per day of production. We didn't get too much into the oil part of his three arrow objectives, but we spent a lot of time on debt management, debt sustainability policy. That was the most extensive portion of the note, and spent quite a bit of time on the economic outlook and obviously the markets as well. Some housekeeping here. As we historically do, we are going to release this Outlook note, put it behind the paywall. We'll do that on Christmas week, Monday morning of it. That's our holiday gift to you all. You'll get a chance to go through this very extensive note. It's roughly twice the length of a typical weekly. And we would urge you all when we do that to please have a look at the note. This week we'll get out a briefer note where we catch you up on the current incoming data, last week's employment data in some greater depth, and this week's inflation data and the market's reaction to all of it. The following week we'll release our annual thematic note. That'll only be fully available to our paid clients, and then our year in review note will come out the week after that, and that'll pretty much wrap up 2024. So the bulk of this note, as I mentioned, was really not the bulk, but the biggest portion of it anyway was covering policy. We spent a lot of time on our whole of government approach to debt management, the idea that Treasury would lengthen issuance, the Fed will keep QT going longer than they would otherwise, and the Fed will be able to cut the policy rate another 100 basis points after they cut in December down to about 3.25% or so. This will relieve a lot of the pressure on small businesses, more evenly distribute policy tightening across the yield curve so that longer term, high quality borrowers bear some of the burden, not just placing it all on small businesses as the Fed's been doing for the last couple of years. The biggest beneficiary of the threat to bureaucracy will be the financial sector, the end of the Basel Endgame, and the sequencing of tax and trade policy matters a lot. As far as the economy goes, we expect a recovery in CapEx. We think productivity will continue to be relatively robust, although productivity is a bit tricky. We dug into whether what we're seeing now in terms of strong productivity growth is being driven by cyclical labor market forces like the big great reallocation between mid-21 and mid-22, or it is being driven by technology innovation adoption. And that, of course, is a crucial question for the economy in 2025. We don't think the growth rate will accelerate this year, but the mix will be much more favorable for equity markets and to an extent the debt markets. Lower government spending, increased CapEx is a very positive outcome if that indeed is how it unfolds. We think that trade policy will have a smaller impact on business confidence and stock prices than it did in 2018. This is sort of our theory of shocks. The second shock is never as painful as the first one. And we do think weak demand for labor will persist at least through the first half of the year. The problems in the small business sector are not just tax policy and regulatory, it's actually financing rates. And so the Fed's going to need to cut rates quite a bit more to really relieve the pressure on small businesses. As far as the markets go, we think 10-year Treasury will wind up the year about where it is now, about 4.2%. Twos will rally and the rate will be closer to 3.5%. This will put that twos, tens benchmark yield curve at 70 basis points. It's close to its long-term average and a much better situation for small banks. We think mortgages will tighten to treasuries. The benchmark Fannie or Freddie 30-year current coupon rate will be around 5. That'll bring mortgage rates down a fair bit. We don't really like IG or high yield credit all that much. Still, We do think this is the year where the equal weighted S&P will outperform the cap weighted S&P despite some of these flow related forces. We have the S&P up 10%, about in line with earnings, but the equal weight doing better. The equal weight's quite a bit cheaper, and because we expect that CapEx recovery, beneficiaries to that, like industrials, energy, and materials, will perform well. The financial sector will perform well because of deregulatory policy. Tech we have penciled in line right now. We could see reducing exposure to it over time, but it's a little bit early for that, and we would avoid healthcare and staples. So that's it for me this week. Again, we'd love for you to consider becoming a full subscriber so you can keep up with us throughout the course of the year. And please, when that note gets released beyond the payroll, have a look at it and consider becoming a full subscriber in 2025. Barry Knapp from Ironsides, thank you.